Okay, so really quick video here. We've got a new recruit coming in who's a car salesman who's looking to get back into the life insurance space. And he asked kind of like, what does our consulting do? And how do we help people? And like, what's our agency really about? What's our business model really about? Will he like it? Will he not like it? And I was like, well, let me shoot a quick video and demonstrate exactly how we're helping families grow millions of dollars, create generational wealth, pay down their debt, and do it in the fastest time possible with the most amount of flexibility and freedom. So I'm going to share my screen and show you exactly how I'm doing it. Come and join me. All right, so first thing you're going to notice here is I have built a generic freedom number debt payment calculator. And this payment calculator is really different from other calculators in the sense that it's not going to be verbatim how, oh, what's the guy's name? He's really, really famous and he tells everybody how to manage their money. Yeah, that guy, you know. So we're not going to do exactly the snowball method like he does, but we're going to do the freedom method. It's very different, but I think in my mind, it's actually better. If you love Dave Ramsey, I also love Dave Ramsey. He's a huge success. He clearly knows what he's doing. However, if you're actually trying to leverage some of your debt and maximize it as an investment vehicle to accelerate it and protect it at the same time, this is a technique that Dave Ramsey probably won't agree with. However, Dave Ramsey is for a very specific audience, and we're for a different audience. That being the case, let me show you what that means. So, the way that this freedom calculator works, you're going to put in your credit card or your debt, whatever it is. Pick a credit card number, and the first thing that you're going to know is what is the actual interest rate on the credit card debt. And you're going to make 12 payments for the year. And that would normally tell people what their actual monthly fee is going to be. What we're going to do is really different. We're going to take the balance of that credit card debt and we're going to prioritize the balance that can be paid off in full, paid off upfront. And then we're going to divide that balance very simply by the monthly minimum payment that is required. Okay. So if you're building a sheet like this, or you can just simply email me and I'll give you a copy of the sheet. You can join our community and it's in the community already. You can get a copy totally free. I just want you to have everything you need. So you'll notice that this cash flow index, and I built a little bracket in here, a note so you can read it. What we're aiming for is a high cash flow index number above 100. And we're really, really, really worried about any cash flow number that is 50 and below. Okay, I'll explain the math in just a minute, but the lowest number is the highest priority to pay off first. The higher the number, it's actually really good debt for you to keep, and you may or may not even have to pay it off early if you don't have to. Okay, so rule of thumb, if it's a low number, you want to pay it off. The lower the number, the bigger the urgency is for you to pay it off. For example, right here, this is a 13. You'll notice this line is a 13. So what we would do is look at paying that off immediately because it's the darker red. Then we would go to something like an orange for this 22. And then we would go to the 25. And then we would go to the 30s. And then we would go to the 34. And then we would go to the 48, the 99, etc., etc. So we're literally going to index how we want to pay this off. Our snowball order that we're going to do is based upon the lower number all the way up to the highest number. It's a real simple math equation. Literally, all you're doing is taking the total balance and dividing it by the monthly payment, the minimum that you have to make a payment on. It's that simple. That's the equation. You can do this number for yourself. Okay. Then the next step that we're going to do after I figure out that the first priority is going to be this discovery card with a $440 balance and only a $35 monthly payment, but it has the worst freedom score, the worst cash flow index score. So it's my number one priority to pay it off. Okay. Brings me to step two. Now that we understand how the tracker is going to work, the next thing that we're going to do is focus on how much income do we have, how much recurring expenses do we have, and then what's our total debt balance. And if you'll follow me up here in the top left corner, I'm going to really dial this in. Okay. So I took exactly verbatim off of this one case study, and he makes an annual income of about $80,000. He gets that in two different ways. He has a base salary of about $4,000, and he has some rental income of about 2,700 that comes in. So his total monthly income before taxes is 6720 or $80,000 annual. Now, pause. We're trying to use this rental income to get zero taxable income. So even though it says he's making 80, we're going to try to write off all of his spent expenses, all of his deductions through his LLC and his rental properties. Okay. So I'm going to save that for an additional video, but just know we're not looking at his net. Because his gross and his net are almost exactly the same because we set up his business entity correctly and his expenses correctly. Okay. So his actual expenses are going to be $4,000 and 40 $4,009.41. And then that is an annual of $48,000 112 and 92 cents. Okay. So if you're out there doing the math, hopefully that math is the right math. If not, leave it in a comment. And then his overall debt on all the debts combined, it is a maximum debt of $173,509.22. Now, how we got the debts, we calculated all of his credit cards. So we added up the balance here. We added up those credit cards that are business credit cards and personal credit cards, right? So that's a business credit card. These are personal credit cards. And then we added up his mortgages and the balances on his mortgages, even his vacation rental properties that he's going to pay to go to his vacation resorts, right? So they've got a vacation property for the family, and they've got two rental properties that they owe mortgages on. And you can see that that's 152 plus 15 plus 6, or a total right here. You can check the numbers of about 173. Okay, so his cash flow that he has left over is the income minus the expenses, and his actual usable cash flow is about $2,700 a month. Or if we take 25% of that and we put 25% aside for a rainy day, for an emergency, for a what if, then we only have a leftover of about $2,000 a month that is additional money that he can put towards something. He can do whatever he wants with this additional money. So if he's making a lot of money, maybe he wants to put it into an investment. But in my case, we really want to pay down all of that debt, and we want to knock out all of this credit card balance and get him where he's got nothing but cash flow, positive cash flow on assets. Okay. So if you're looking at this in a normal world, he would have to come up with about $14,000 a month to pay this off in one single year. Now, he doesn't make $4,000, $14,000 extra. So we're not talking about he has additional like side hustle income to pay it off. He's going to actually use a calculator of just his available cash flow and then pay it down. Okay. So We looked at his total annual cash flow that he has available. It's 24,395 and 31 cents. And at that rate, it's going to take him 7 years, 7.1 years to pay all of this debt off in total. But we're going to do it in a way to not only pay off two mortgages, all the credit cards, but we're actually going to protect it with about $4 million dollars, and we're going to grow his cash value account to over 300, $400,000 in his retirement fund. Okay. So for that step, what we're going to do is build a home equity line of credit. Okay. He already has two rental properties. He has equity in the property, and he has the ability to go get a loan and secure a home equity line of credit. Okay. The terms of the line of credit are simple. He's only going to borrow the maximum amount of cash flow that he has available left over after he pays all of his expenses. Okay. So his cash flow again is 24,395. So we're going to let him borrow a HELOC of something like maybe $30,000 or $25,000, something like that. We know that the interest rate on it right now is about 9.99%, and we can calculate that monthly payment maxed out. Okay. So what we're trying to do is pay off the entire home equity line of credit in 1 calendar year. We're going to pay it off in 1 calendar year, and then we're going to borrow the same amount of money in year two and keep borrowing that money. The reason that we do it is very, very powerful. Okay. So this is a combination of what people call velocity banking. And here's why. If you see this $24,000, he's going to get it deposited into his checking account. He has access to all of that money. Okay. So in year one, he can pay that $15,000 and knock out every one of those credit cards. Then he has a little bit left over and he can put it towards his business credit cards, right? So this combined number is just about $21,000. Okay. So if you do the math, that's about 6 grand and 15 grand. That's about $21,000. But he's got access to 24,000. So he can literally pay off every one of the credit cards and stop making 29%, 27%, 27, 29, 13, 25, 10, and 25. He can stop making all of those credit card interest payments that accrue daily and exchange it for one single HELOC payment. Okay. So this payment is basically like a 30-year fixed mortgage, and he can split that up over 360 payments. Now it's amortized and so it's interest heavy up front, but the payments are not that terrible. Okay, so that $24,000 is basically 24 times that amount, then divided by the 360 payments. And the HELOC is really, really cheap. The monthly payment is like $7 on a HELOC like that. $7 to pay off $21,000 of debt. And he gets to save all of that interest up front. But it doesn't stop there. For us, that's not a good enough way to do it. So what we're going to do is build him a life insurance policy that has cash value, and there's a buzzword behind it, kind of popularized by Nelson Nash, called an infinite banking whole life policy. For all of you IUL lovers out there, I'm sure there's a world in which an IUL makes sense. That's not what we're going to do. That's not what we're going to focus on. This is a whole life policy where the premium never goes up There's no money market involved. There's no additional fees. There's no hidden costs. There's no accruing costs that go up over time. And you might say that an IUL might eventually outperform. I don't care. To simply say it, I'm going to focus on whole life because it's guaranteed with certainty. So we're going to focus on that. And what we're going to do is put this entire amount of money into his cash value account. And it's going to earn 6% on that account. So he's going to profit a little over $1,400 in dividends on the first year that he puts it in there. And he has a monthly payment of $7 that cost him to originate and borrow the money on the HELOC. Now, what he's going to end up doing is taking this full amount of the HELOC and he's going to take a loan out against his policy to pay back the HELOC. Let me show you what that means. Okay. So he's going to take the full amount and then we're going to multiply it by the loan rate of the infinite banking loan, which is going to be approximately 5%, but his money is going to earn at 6%. Okay. So he's going to pay off this entire loan within the next 30 days and it'll be paid in full for the whole year. So he won't worry about the HELOC payment at all. That will be paid, but he will have this $24,000 to pay off in an insurance policy. And if he doesn't pay it off, he's going to accrue $1,200 in interest if he doesn't pay it off inside of the policy. Now, there is no demand that you pay off the policy. The only thing that the policy says is you can't borrow more money than is available inside of the policy. So he borrowed exactly the 100% of the amount available, which means he will not be able to borrow any new money until he pays this policy down at the end of the year. So what he's going to do is take this cash flow right here and make a monthly payment every single month and pay down his policy. So he will end up making exactly $24,000 worth of payments, and this payment will go back down to zero at the end of the year. However, he will have accrued some interest that he will have to pay off later. I'm not worried about the interest because he's going to have all of this money accruing inside of his account. And his interest here is 1,400 and the interest here is 12. So he literally paid down $21,000 for free. Like, I hope you understand what I just said because he has just a little bit extra money left over. Let's show you what he did to win that arbitrage. Okay. So this is the amount of interest that he earned. This is the amount of interest that is going to be charged against him at the end of the year. So he paid a total of $243.95 a month in that interest. But look at how much his payments have been all this time. So this one credit card has $121 of interest every month. This credit card, 121, 190, 400, right? So you can add up all of that and realize this is almost $400 a month that you're paying in interest. And if you max that out across the year, you'll realize this is over $4,000 worth of interest that you're giving to the credit card company. Or you can pay it 243 and then you go, well, what's the annual for that? So the annual obviously is $1,200. So you're winning a positive $243 a month for borrowing it like this. All it cost you was 1,200 instead of $4,000 of, and this is your money and not the bank's money anymore. So now I'm going to scroll down to the bottom here and I'm going to focus on the insurance protection side of this. Okay. So in year one, this policy starts out at about $3 million. But by year seven, this policy is over $4 million in death benefit. So if you died, your family is going to get 3.3 to $4 million, somewhere between 3 and $4 million gets paid to your family if you died while you're trying to pay off all these bills. So it pays for all your houses, pays for all your credit cards, and it gives them, look at how many years of wages that is. Okay. So let's say that your total amount is 173 and to pay off everything. But then we want to find out what is 7 years of income. Okay. So you take your total amount times the years that it's going to take to get there. That is only $573,000. So if you saved every penny that you earn for 7.1 years, you've only saved $573,000 to give straight to your family. That's debt free. You have no debt at all. Every single penny goes directly to your wife and kids, or spouse, or loved one, or whatever it is these days. Who knows? Um, but it's only 573. So if you take that and the debt and combine it, what you're doing is helping them out. Over $700,000 can wipe out all the debt and give you 100% of every paycheck. So the number that we're actually trying to beat is this number, right? This is the biggest, baddest number that we can possibly challenge to be perfect. And you'll notice here that if I've got $4 million, that's definitely better than 700, $800,000. Okay. How much better is it? You take the number protected and you divide it by the overall amount that I can do it. This is 500% better. Like, if you really understand, this is 535% better doing it this way. I don't know what it takes to convince you, like how amazing this is for us helping other families. In 1 year, we have made you 535% more protected and have better outcome by using this technique. Now, you didn't get a pay raise, you didn't change jobs, you didn't add to a 401k or a 403. It's not a Roth, it's not an IRA, it's none of the traditional things that everybody's using. It's knowing how to do a few different things. It is complicated. Yes, you got rental properties, so that's one part of it. Yes, you've got a good tax strategy. That's one part of it. But then you've got the velocity cash flow index. You know how to leverage a line of credit, and you know how to put it in an infinite banking policy. It's 5 steps. It's hard steps. I don't want to say this is for everybody. Clearly, it's not. But for the people that really understand it and get it, this is fucking amazing, is what this is. Okay. Now, let's look at the projected contributions after 7.1 years. Okay. So all I'm going to do is swap this amount by the number of years needed to pull it off. And you'll notice that I have earned a new $74,000 worth of dividends, and I have a total contribution of about $250,000 in cash sitting in my cash. Why I have $4 million worth of life insurance, and all of my debt is paid down to zero. All of my rental properties, all of my credit cards have been zeroed out, and it took 7 years to get there. So you've got cash available, you've got insurance protecting it, and you've got a strategy to do it. But it gets even better than that, because what if I just simply want to take that amount of money and just keep funding my life insurance policy, but I don't have any expenses anymore? So this expenses right here, this $48,000 can get added to the $24,000 that you have. So you really can turn this future projection into almost $70,000, right? Because you take these two numbers, the 48 that you currently have in expenses and the cash flow that's available, and that is the new amount that will be available in 7.1 years. And then you can come down here and you can add your contribution of $72,000 a year. So once you get past these first 7 years, you can put virtually your entire remaining paycheck in here and run everything out of this account. Okay. Now, this is shooting for the moon and really, really going after it. And I'm going to pause on doing that. So you'll notice that this number D6 right here, I could technically make it D7 and show you what D7 is for another 7 years after that, right? So we're 14 years in, and now I've contributed another 500,000. I've got 220 in dividends, and I've got 700,000 new money in my account. So in less than 15 years, we got virtually $1 million in cash, plus the $4 million plus in the life insurance. And that's going two rotations without buying new real estate or anything like that. Now, the question is, once you've got $700,000 in your cash value, how much money am I earning in there? So let's say it's 6%, same number. And let's find out what that new amount of money is added to your cash value each year. So now you're earning $44,000 in dividends, guaranteed in writing, guaranteed new dividends. And that is a full-time retirement plan. That is your retirement. That is your pension money. You can take that 44,000 out a year and never touch your premium, never touch your cash balance, and just live off the dividends, just the dividends alone. Now, you could say, well, it's half of what we're used to making. It's true, but your current expenses are $48,000. Your dividends are 48, 44. So you're almost living within your expenses already. And you did it in less than 20 years, less than 30 years. That's how powerful this thing is. So let me show you an example of what a policy like this really looks like so that you can wrap your head around these numbers. Okay. So we're using this example. He's a 35-year-old. He's making 80,000 a year, and he's starting right around age 36. Okay. So his whole life is $250,000. But we also got him 2.5 million in term for 20 years so that we can get him the maximum amount of insurance for the lowest amount of premium. Like the insurance agent is making virtually no money off this because we're stacking it in the customer's favor, not in the insurance's favor. Okay. So the monthly payment for $3.3 million is just 600 a month to get your family 3.3 million. But look at what happens. So you're going to put in that $29,000 in cash value each year. And it doesn't seem like a lot. You're going to get $300 in dividends and you're going to buy some new paid up editions. And the death benefit is going to go from 380,000 to 381,000. Okay. So you could see this number buying the new dividends right here. Then they're adding the annual and putting the total combined. Okay. So year two, he's gonna borrow that money. He's gonna put the same cash into his cash value. So he borrowed that from a HELOC. Okay. Let's go back and just make sure that we understand. He's taking this money right here from the HELOC that he can afford to pay back in 1 year because we know what his cash flow is at the end of every month. So he's going to take that exact amount, he's going to borrow it again from the HELOC. He's going to pay straight into his insurance, and then he's going to take a loan against his insurance policy and pay the difference. But what happens now is he's got 2 years worth of payments instead of one. So this amount right here is going to double because he's got 2 years worth of payments in there. Okay. So it's this times 2 years. So now he actually has $48,000 in his cash value account. He earned $3,000 total worth of interest. And if he doesn't pay it off in that year, the maximum that he's going to lose is $1,200 worth of interest. The maximum that he's going to lose. But we know that he paid off every credit card. And then the only thing that he's got left to pay off is the actual mortgages down here at the bottom. See, none of this $21,000 has to get paid in year two because it's already paid in full. So the only thing remaining down here is this amount. And he's going to put 25,000, roughly $25,000 towards these debts. Now, the way that he's going to focus on it is he's going to start at the worst number there is and make all of his payments to that number. So this is a 48. It's the worst number because we want the lowest number. And so he's going to put all $25,000 towards this, and he's going to keep paying it and keep paying it and keep paying it until it hits zero. Then he's going to take that $1,300 that he used to make that payment, and he's going to add it to this amount right here, the 99. So 1,300 plus the normal payment is going to get added to the next one. And then this loan is going to get paid off. And then he's going to switch to this one. And then he's going to finish at that one. In that order. You can't skip that step. Okay. So he'll pay this loan off first entirely with just the excess cash flow. And then he'll focus on the next one and pay it off. And then he'll focus on the third one. And then he will finish with that little tiny HELOC. And the reason that he doesn't want to pay that HELOC off is because the monthly payment is so low and the balance is so low that he doesn't have a lot of interest that he's losing. See, we're focused on how much interest am I losing if I don't pay it off. I'm losing $26 a day that I don't pay this one off. I'm losing $2 if I don't pay that one off. So we're prioritizing where you're losing the most interest and paying that down first, and then rolling that over and rolling it over and rolling it over to the finish line. Okay. So as we do that, he's got 55,000, but look how much life insurance is going to go to the family now. It went from 3.3 to 3.5. That's because every time he adds more money to his cash value, it's going to buy more life insurance. It has to by law. And then those dividends and the accumulated paid up additions are going to get added. And now he's got $56,000 available to borrow, but he only has to borrow 29,000 a year. So he's earning more interest than he has to borrow every year. So in year three, he's got $89,000 growing earning interest, but he's only borrowing $24,000 to pay down the debt. Now, if he wanted to, he could technically borrow all $89,000 and pay everything down at once. So let me show you what it's going to look like at that point, because there's going to be a break even moment where after he pays down this $21,000, then the next years he's focused on paying down this $152,000. So after he gets used to paying that 152,000, all we're looking for is 152 minus the 24,000, let's just say 25 that he can come up with. So in 2 years, he'll pay 50,000 towards this. And what we want to focus on is when will he actually have $100,000 in cash? That'll be year four. So if you will look right here in year four, he will have over $100,000 in cash value. He'll have over $3.7 million in life insurance, and he can borrow the total amount in year four and pay 100% of his mortgages off. So in year four, he would have all of his mortgages paid off. And then the last 3 years, all he's doing is making those payments to pay back the loan inside of his life insurance policy. But if you think about it, if he borrows the $119,000, the only thing that he's losing is the 5% interest on that $119,000. Call it 120. Okay. That's the only money that he's losing. It's just the interest on that. And if he's willing to, he can choose not to pay it off and just let the interest grow. And what'll happen is at the end of his life, it'll just come out of the $3.7 million that's growing. So every year that he adds more money, his arbitrage is going to keep growing and outpace the loan that he borrowed to get started. But notice that as he keeps the policy, he keeps adding 7 years later, he's got $225,000 in cash and he's got $4 million in life insurance. So he can take that extra money now and go buy more real estate and create more rental properties. And if you know how to use commercial real estate, 225 is the 20% needed on a $1 million commercial real estate deal. And that'll get you about 16 rental units, commercial rental units for $1 million. So let's just say it's a 10 units that you can get for that. So I would be focusing on the fact that he can put $225,000 down to the bank to secure 20% down payment on a commercial mortgage, right? So what that would be is a little over $1 million, right? So the simple way to do it is $200,000 times five would get you there. So this is technically he can borrow $1.1 million with that 20% down payment. And that can get him a 10 unit rental property. Okay. And if the average rental price is $1,800 and it's 10 units, that means he'll be collecting about $18,000 each month annually. That's $216,000 in annual rental income. And he's only going to keep 10%, right? So let's say he's got 90% in expenses, and this is his pure profit. So he's now got $1 million worth of equity growing. He's got $1 million worth of depreciation that he can write off of his taxable income, and it's going to grow over time. The rent is going to increase over time, and it's an immediate brand new $21,000 of new income coming in. And he did that, and he was able to do that within 7 years of that policy being alive. So now he gets to add this new rental income right here. He gets to add an additional $21,000 to the new income. Does that make sense? Future rentals would be this new $21,600. Okay. So we can take that, and that's giving him only 10%, right? So that's not outrageous. I know plenty of people that make 25% on their investment. So 10% is really, really nothing. But now, in just 7 years, he's making $100,000 and he's debt free and he's earning $44,000 in dividends down here and he's earning this rental income up here. Oops, stop that. And then I'm going to add his original income right here. So now you can see after 7 years, he's actually earning $146,000 with his life insurance account his new rental property plus his original rental properties that have no mortgage against them at all. So he now has all of this money for a HELOC that he can come in here and borrow, you know, even more money for another HELOC. Plus, he's got the money inside of his life insurance account that he has. They're set up forever, and it only takes 7 years to get there. Again, I know for a fact this is definitely not for everybody. It demands that you're very, very strict about how you spend all 7 years and what you do and how you do it. So it's definitely not for everybody, but for the people that can, a combination of a freedom index calculator to show you which credit cards or which debts to pay down first. Max, add that to a velocity payment structure, leveraging a HELOC, and add that to an infinite banking strategy, and then add that to a tax strategy where you know how to write off your taxable income and deductions and depreciations. And if you can get to those steps, you can be a millionaire in the first year because you'll have $3 million that'll go to your family. So you'll be a millionaire, and then you'll have 1 million under assets in 7 years, and you'll be making 150. You'll double what you're actually making, and you'll have your rental properties. This is a no-brainer. So this is what we do. And this is how we do it. This is exactly how to do it. Anybody can follow this blueprint on YouTube right now, Facebook, wherever, LinkedIn, wherever you're going to watch this from. Anybody can follow those steps to get there. And at this point, if you've got any questions, I'm happy to answer any questions you might have. If not, thank you so much just for tuning in. Uh, Dustin or Jennifer, if y'all have got any questions, y'all can hit unmute. Y'all can come in. I can share my screen again or answer anything that wasn't clear.
I think it was pretty clear.
Okay.
Um, it is a very disciplined strategy to execute. So but I think I see how you're able to your infinite banking moves your money. You're moving your money into your to pay your debt and to pull it back and to pay it forward. So you're accelerating your debt payoff um, while you're still growing at a moderate rate in
Yeah.
your life insurance fund, figuring out how to become instead of a debt collect consumer, an investor because you're adding property to your portfolio so that you can cycle that. And then there's one more part to that, and it's oh, you're protected with life insurance
You're,
in case you die.
you're
Like I mean, yeah. So like as you're executing this 7 year plan, if you don't make it, your loved ones are protected. Okay, yeah,
Yeah. So what we tell people is right off the bat, step one is to get the insurance in place. So at least your loved ones have a potential of $3 million, which is technically 500% more than you have available for them right now. If you were to stay alive and give them 100% of your paycheck, it would still take you over 5 years to get there. Right.
right, yeah.
So you're literally giving them 5 years worth of your paycheck, and you're paying off all the debt at the same exact time. You're getting both of those things knocked out of the way as the step one. Yeah, good point.
I think definitely seeing the visual and having you walk through it definitely helps will help everybody understand how to navigate and how things are related. And I think that's going to be very helpful for people's understanding the the whole idea behind um, why it's important to do things in that order
Yeah.
for sure.
So for me, this originally started as my military legacy wealth builder. That was just like my little made up name because I wanted, while I was in the military, to be able to create a legacy and like leave a legacy builder in place. And then, like, for me, it was learning how to leverage my first HELOC, stop using my military insurance and my military retirement plan, and actually go build my own, uh, buy my own houses and then leverage them into rental properties and then keep put all that money inside of a life insurance policy and just keep growing it, year after year. So you start doing that in the military for 10 or 15 years, you're a millionaire when you get out. And it had nothing to do with like your military retirement. This is just like you built your own portfolio of rental income, no taxes at all, and then your life insurance income, which is in the form of a dividend. So you've already got multiple income coming in and you haven't even retired from the military yet. And then if you do get that retirement, it's a bonus right on top of it, but you don't need it. You're not relying on it. This strategy works for everybody that I've came in contact with, right? It works for teachers, it works for police officers, firefighters, bakers, butchers, cashiers, like servers. It works for everybody. The only thing that changes about the strategy itself is how to get started, right? How to get your first house so that you get access to the first HELOC and get this thing off the ground. And then whatever your annual income is, minus your expenses and your cash flow, will determine how fast you can get there, right? Everybody can get there. It's just a matter, does it take 7 years or does it take 10 years? But I've never seen it take longer than 10 years for anybody at any pay salary that's making minimum wage. Like, so anybody that starts at minimum wage has the ability to get there. And again, even at minimum wage, they can afford to get a $3 million life insurance policy, right? So even if they died at McDonald's or anywhere else that's minimum wage, they can immediately gift their loved ones with $3 million. And then they slowly have to figure out how to get the HELOC or a credit card or a line of credit, however. And then once you get that line of credit, then you can put that in your life insurance policy and then immediately borrow out of it and start the cycle, right? So sometimes it takes an extra year of people saving their paychecks, saving everything to get to some more cash flow. Cash flow is king. Like the faster you can get to cash flow, the better. But everybody can get there. It's just a matter of if it takes 1 month, 1 year, or to get there. Anything else that y'all saw or had questions about? Any on the Excel sheet or the life insurance policy that y'all needed answered?
I think I'm okay.
Amazing. Well, I appreciate it. Y'all have a great night and I wish y'all the best.
Okay,
Thanks
thank
so
you.
much.
Bye.
Okay, bye bye.